Okay, so if you've already mastered the pennants, the flags, the trend lines, everything we talked about in previous videos, this is going to be something a little more simpler and something that you can follow a little bit easier because it's an indicator technique, and I really didn't want to put this in here because I hate indicators with a passion. When I first started trading, I was a really big indicator fiend, and I really couldn't find anything that really worked for me as a person. But I'm going to show you two different techniques using indicators that have really helped take my trading to the next level. And they're working off very simple techniques using moving averages and also using, or just using moving averages basically. The first one is going to be a 50, no, it's going to be the 21-8 method. Okay. The 21-8 method is generally utilized by taking a 21 period simple moving average. Okay. So take a moving average. And you're going to, if I can get this right, format it. There we go. Input. Your simple moving average, SMA, is going to be 21. Why? Because this is the slow one. This is the one that moves the slowest. This one's going to be red. Going to leave it. Okay. The next one, you're going to go back to your indicators. You're going to look for moving average exponential. This is a EMA, exponentially calculated moving average. Okay. Take this, put this as an 8, bright blue. You need to see this. Okay. Now, this in technique encompasses a few crosses. Okay. It's basically you're going fast and slow at the same time. It's kind of interesting. It really helps you follow trend a little bit more accurately. But don't get it confused. This is not something solely to take trades off. This is just a backup for if you understand how the market is already working, and this is just a backup to follow trend. You know. So what exactly this technique encompasses is that if you're using the moving average cross technique, what you're more or less looking for, you're basically looking for the blue or the exponentially calculated moving average across the red one, and the direction at which it crosses gives you the overall decision on the fast. It's like a fast twitch. It gives you an alert, like a lookout for where the trend is going. So, say let's go here. If the market is moving sideways, we have a close above break. We have a break above, close above the blue and the red EMA at the same time, right? Okay, this is against trend. You're not going to want to take this just yet. You're going to want to make sure you have different confluences that line up properly, because if you don't, you're going to you're really going to suffer on the long end. You always want to follow the trend, unless you're doing counter trend trading, which I don't really recommend. But anyway, we're going to take this from this. Why is my screen messed up? From this high to this low. Okay, 50 didn't click 61.8. You're still looking for that reversal, right? Once you get that reversal after that resistance, then you can short the market, right? See, more or less, as traders, you'll probably be looking into the market just like this. You probably come in, looking at the market from high to low, inside return, 61.8, saying, okay, I can probably take it for a 161.8 because this is what Chris has showed me in previous videos, and this is what I've practiced day in and day out, and I've come to understand, right? Good, good. That's just awesome. I really like that. Now, what you're gonna have the high to low, the inside return at 61.8, the 161.8 confluence, and you can have more confluence with how the candles close at over the trend lines. I mean, or not, over the moving averages. So if you're looking at the market as such, the high, you have a low, the inside return, you have 61.8 rejection away from that level, away from previous resistance. This sideways consolidation right here, which is more or less some kind of pennant or flag pattern if you look at a small time frame. And you also have, what do you have? You have a bearish candle closing below the blue EMA. What does this tell you off jump? The underlying motion, the faster motion of the chart is looking to go down. With trend, this is your solidified entry. Okay? Now, what you're gonna do is you're gonna if you took a trade off this close right here, this close below, came back above, like above right here, above 61.8, you target the 161.8, you're still in nice 3-to-1 above 3-to-1 and above ratio. Okay? 3-to-1 and above ratio. This is beautiful. Okay? Now, how can we utilize this technique a little more often? What do you see right here? You see a break above, close above. Okay? You see the market becoming exhausted. Why? How do you know the market is becoming exhausted, right? The market is becoming exhausted because look at the previous price action. Identify the consolidation like we did before. Market came within this zone, within this area, became exhausted, rejected off this area, pinned off this area right here. Okay. After it pins off this area, what happens is we see a nice rejection, we see a close above, we see some counter trend. Oh no, he didn't. We see a counter trend movement. Um, that gives us the possible opportunity to short the market or long the market. Now, what's going to happen is that if you actually do the market like this, you can use a Fibonacci for a nice take profit target. In this case, you're going to use the overall high into the low. Go back and redo that a little bit, and you're going to target at least 38.2. Okay, that's the first one that we always look at, 38.2. Okay, if you long the market or went long inside the market for a counter trend move, say about right here, stop loss goes right below. I promise I'm not doing this on purpose. There we go. You still are almost in nice 3-to-1 territory. Okay. Now, the kicker with this is that you can use this technique very fluidly, multiple times. You just have to really be careful at how you understand it. In this scenario, we had a close above, break above, close above, break above, close above, reaction off the smaller area, reacts off the smaller areas, and you get some nice AB equals CD patterns in here. Okay, where are those AB equals CD patterns that we always long for? From low to high, 38.2. Take the equivalent distance if you so feel like the market is going to follow your analysis, and then follow the trend all the way up using the moving average. Just make sure you don't have any significant closes below. Okay, you don't have any newer lows being put in. Okay, now let's move on to the next one. So the next instance of using moving average is not going to be a 21 SMA and blue EMA. We're actually just going to use one solid simple moving average. And I used this a lot when I was in Singapore. Anybody who is my student already was my student in prior, and you've already seen me use the 50 EMA. After the 50 SMA, you've already seen how I utilize it and to what degree I utilize it. So particularly what I do is it just kind of smooth. A moving average, supposedly, it just smooths at the overall trend. And once the trend is broken, you can then see the crossover. And once you see the crossover, you'll see the escalation. And this may look a lot smoother to you than just using the 821. It's honestly just personal preference. I like using it a lot because I can follow the Fibonacci step all the way up. From, like, say if I did from this low to this high, back down in, and utilizing the step. Understand we have a step right here. You have the 127. Oops. Still haven't figured out what's wrong with my mouse yet, but hit the 127. Pull it up a little bit. 127. And then keep pulling up a little bit. Particularly this way of trading, it was really profitable to me. Because it really never got old, because you could have just really followed the trend all the way up, especially on the U.S. dollar against Canadian dollar back last year, actually back 2014 when it was really rising. Basically, what you're looking at the bounce off the trend lines, from the low to the high to the inside return at some Fibonacci retracement level, and you're basically just looking for a low into the high at the 50, 50 on 50. You're looking for either 261. I'm sorry, you're looking at 200% expansion, and you're also trying to follow the Fibonacci step technique. If you want to utilize the trend line, also that's really good because you're using everything. You're finding more pieces of technical analysis to really help you follow your decision on the market, and that's good. That's what you're supposed to do. Okay, so you can utilize this technique also, and it's really actually really simple. Seeing it on different like in different forms of the market, like an uptrending market, a consolidative market. In the consolidative market, you'll see it really kind of just leans over to where the actual entry will be, more than just waiting for it, which is really good if you don't have like that much patience level. Um, we don't get that third trend line bounce, and we do get the escalation. We do get the reaction rate from the area. We got a bearish engulfing candle closing below the trend, I'm sorry, the moving average, below candlesticks, following that momentum all the way down. Take the break of structure at the 127, or if you want to take a Fibonacci retracement from the high into the low, inside return 88.6. You can do that also at the 113. That means your entry would have been significantly higher, which would have been good, been cool. Um, so this technique can be used. Let's look at the euro against the US dollar because that's very interesting pair to look at sometimes also. Um, you can very well see the crossover, utilizing the crossover technique, because now you have an ascending market where you can follow trend as long as nothing else closes below this moving average. Okay, let's get the Australian dollar against the US dollar. Okay, pay close attention to how things react. Scenario one, and then the second scenario. Okay, practice those two techniques, work with them, master them, move on to the next level.